US banks are pulling out of China, and it's making headlines. This is not just a minor adjustment, it's a significant retreat that has caught the attention of financial markets and analysts worldwide. Big names like JP Morgan, Bank of America, and Citigroup are reducing their exposure. These financial giants have been deeply entrenched in the Chinese market for years, but now they're rethinking their strategies. They're selling off assets and cutting back on lending. This means fewer loans to Chinese businesses and individuals, and a significant reduction in their overall footprint in the region. This is a major shift. For years, these banks saw China as the next big thing. The Chinese market was viewed as a land of opportunity, with its rapidly growing economy and burgeoning middle class. Now, they're heading for the exits. The reasons are complex, involving geopolitical tensions, regulatory challenges, and changing economic conditions. This isn't a few small banks either. We're talking about some of the largest financial institutions in the world which have billions, if not trillions of dollars in assets. We're talking about trillions of dollars in assets. The scale of this pullback is enormous, and it has far-reaching implications for global finance. The moves are sending shockwaves through both countries. Stock markets are reacting, and financial news outlets are buzzing with analysis and speculation. Is this the beginning of a financial decoupling between the world's two largest economies? The US and China have been deeply intertwined financially, but this could signal a shift towards a more isolated approach. One thing is for sure. This is a story you need to be paying attention to. The ramifications of this move will be felt across the globe, affecting everything from trade to investment strategies. So what's driving this mass exodus? Why are we seeing such a significant retreat from the Chinese market by US banks? There are a few key factors at play, and understanding them requires a closer look at the current economic and political landscape. First, the Chinese economy is slowing down. Growth is at its lowest point in decades, which is a stark contrast to the rapid expansion we've seen in the past. This slowdown means fewer opportunities for banks to make money. When the economy isn't growing, businesses aren't borrowing and investing as much, which directly impacts the bank's bottom lines. Second, the regulatory environment in China is getting tougher. The Chinese government is implementing stricter regulations that make it more challenging for foreign banks to operate. The Chinese government is cracking down on foreign businesses, including banks. This crackdown includes more rigorous compliance requirements and increased scrutiny, which adds to the operational costs and risks. This makes it harder and riskier for US banks to operate there. The increased regulatory burden can lead to higher costs and lower profitability, making the Chinese market less attractive. Finally, there are growing geopolitical tensions between the US and China. These tensions are not just about trade, but also involve broader strategic and security concerns. These tensions are making banks nervous about having so much exposure to China. The fear of sudden policy changes, sanctions, or even a potential conflict adds a layer of uncertainty that banks are keen to avoid. They're worried about things like sanctions or even a potential conflict. The unpredictable nature of geopolitical relations means that banks could face sudden and severe disruptions to their operations. In short, the risks of doing business in China are starting to outweigh the rewards for many US banks. The combination of economic slowdown, tougher regulations, and geopolitical tensions creates a challenging environment that many banks are choosing to exit. As these factors continue to evolve, it will be interesting to see how both US and Chinese financial landscapes adapt. The decisions made today will shape the future of international banking for years to come. China isn't taking this lying down. They've hit back with their own financial weapon, dumping US treasuries. China is the largest foreign holder of US debt. They've been selling off their holdings at an alarming rate. In fact, they've dumped a whopping $1.7 trillion worth of treasuries. This is a clear shot across the bow at the US. China's message is clear. They're willing to use their financial firepower to defend their interests. This move has sent shockwaves through the global financial system. It's raising concerns about a potential currency war between the two superpowers. Section 4. The dollar in the crosshairs. China's Treasury dump is a direct threat to the US dollar. When a country sells off large amounts of US debt, it puts downward pressure on the dollar's value. A weaker dollar makes imports more expensive, fueling inflation in the US. This is the last thing the US economy needs right now, with inflation already at a 40-year high. China's move also undermines the dollar's status as the world's reserve currency. For decades, the dollar has been the dominant currency for international trade and finance, but China's actions are a sign that this dominance is being challenged. Section 5. Can this lead to a financial crisis? The big question on everyone's mind is, could this escalate into a full-blown financial crisis? The financial world is on edge, and the stakes couldn't be higher. The short answer is yes, it's possible, but to understand why, we need to delve deeper into the complexities of the current situation. We're in uncharted territory here. The global financial landscape is more interconnected than ever before, making any potential crisis far-reaching and impactful. The global economy has never seen two superpowers engage in this kind of financial brinkmanship before. The US and China are not just economic giants. They are deeply intertwined in a web of trade, finance, and investment. If things spiral out of control, it could trigger a global recession. The ripple effects would be felt across continents, affecting everything from stock markets to job markets. Both sides have a lot to lose. The US relies heavily on China for affordable goods and manufacturing, while China depends on the US for a significant portion of its export revenue. The US needs China to buy its debt to finance its massive budget deficit. Without this financial support, the US could face severe economic challenges. China needs the US market for its exports. A significant portion of Chinese manufacturing is geared towards American consumers, and any disruption could lead to massive economic fallout. A financial war would be disastrous for both economies. The consequences would be dire, leading to job losses, market crashes, and a potential collapse of financial institutions. However, neither side seems willing to back down right now. The political and economic standoff continues, with both nations digging in their heels, making the prospect of a financial crisis all the more real and imminent. Section 6. Expert opinions. Wall Street weighs in. So, what are the experts saying? Wall Street is divided. Some analysts believe this is just a temporary blip. They argue that the US and China are too economically intertwined to allow a full-blown financial war. They predict that cooler heads will eventually prevail. Others are more pessimistic. They see this as the beginning of a new Cold War, this time fought on the financial battlefield. They warn that the risks of a major crisis are very real. One thing is for sure, there's a lot of uncertainty in the air right now. Section 7. The future of US-China finance. A rocky road ahead? The relationship between the US and China is at a crossroads. The financial moves we're seeing are a symptom of deeper geopolitical tensions. It's unclear how this will all play out. What is clear is that the era of easy money and globalization is over. We're entering a new era of great power competition. This competition is playing out in the financial realm just as much as it is on the military and technological fronts. Buckle up, folks. It's going to be a bumpy ride.